Hello, I'm Martin Coyle, Head of UK Business Development for Morningstar Investment Management Europe. Thank you for joining the webinar. In a changing world, do the same investing rules still apply? For investors, 2020 has been one of the most challenging years on record. The sharp falls in asset valuations in the first quarter and gloomy economic forecasts have tested even the most seasoned of investors and established of investing frameworks. So what, if anything, do investors need to change as they plot the path through the pandemic? Does the new economic backdrop require a different roadmap? And will the timeless rules of investment still apply in the post-pandemic world? To discuss this and more, I am joined this afternoon by Morningstar Investment Management Chief Investment Officer Dan Kemp and Head of Portfolio Management Mike Coop to discuss whether the principles, timeless rules of investment still apply in the post-pandemic world. As a reminder, you have the opportunity to ask questions online throughout the presentation, and we will look to address these at the end of the session. You'll find a Q&A box at the bottom of your screen, so please participate, and we had fantastic participation in the previous webinars. Like all our webinars, they attract CPD points, and at the end of this presentation, you will have an understanding of the Morningstar Investment Management investment principles. We will provide an update on the COVID-19 pandemic from an investment perspective. You'll have an understanding of Morningstar Investment Management's views on the economy, markets, and investor behavior, and you'll get our latest investment outlook. The CPD certificate should be with you within 24 hours of the conclusion of the webinar. So now, over to the presenters. Welcome, Dan and Mike. Let me start with a question for you, Mike, if I may. The pandemic has had a huge impact on everything and is unique in many, many ways. So how do you take this into account when you do your research and make your investment decisions?
Thanks, Martin, and thanks everyone for joining us today. That's a great question. I think the challenge for all of us is to find a way to put this in perspective. And for us, that means starting with your existing investment principles, which we're showing here. Having a framework for making decisions and then assessing whether the way the world works has changed so much that you need to rethink your overall investment approach. So I'm going to start with these. Some of these principles are values that we hold as an organization, like putting investors first, striving to minimize costs, and being independent-minded. The others are based more on observations about how the long-term behavior of investment markets and successful investing across time and in different countries. So let's have a look at those to see how they look today. Investing for the long term, that's really about aligning to our end investors' need to build wealth or to live off their wealth, and the focus of the investing industry, which tends to be very much short term, and that means there's opportunities for those who are prepared to wait a bit longer for the payoff for their investment decision. So long-term investing is a key part of how we think. We'll have a look at that. Taking a fundamental approach is all about seeking to understand the cause and effect relationships that drive cash flows and how to think about shifts in the economy and how we would value an asset. And then finally, building portfolios holistically simply means finding assets that can behave differently. So those things leave us with valuation. I'd say probably valuation is the one that I would focus on most here. So valuation is really simply the notion that you would want to focus on assets that you could buy less than their fair value if you could. And the notion that when markets are very cheap compared to their fair value, they're likely to do better than markets that are very expensive compared to their fair value in the long run. The thing about valuation-driven investing that's critical is that it means that you don't take for granted things like diversification, because when assets become very expensive, it can affect their ability to be a diversifier, like bonds when yields are very low. And it can also allow you to think about risk in a more dynamic way. So if things have become very expensive, maybe the history of how much they've fallen in the past might not be that indicative of the future. So when we think about those 7 principles, the question for us is whether the world has changed beyond all recognition, so that really economies would need to start behaving very differently. Markets would need to change in ways that mean prices of assets would respond in a different way than they have in the past. And this would therefore also mean that investors would start to behave differently from the way they have in the past. So that's how we've thought about it. Are we seeing a big enough change in how economies behave and how markets are behaving for us to rethink it, given what we know about the pandemic?
Yeah, so Mike, if you're still applying the same investment principles, then when it comes to your research, what impact do you think that the pandemic is having on economies and markets?
And this is the critical question. So we've shown on the slide here a snapshot of a few statistics. So far, there are 25.5 million cases confirmed. There's 842,000 or so recorded deaths in over 200 countries, and there are 33 vaccine trials in operation. To put this in perspective, the world population is 7.795 billion. Seasonal flu deaths worldwide have ranged from about 291,000 to 646,000 a year, so we're through that. And even with this information I'm showing you, we know that we should treat these numbers at best as an educated guess, because we don't really know how many actual cases are being recorded. And countries have applied different definitions of deaths in terms of whether they were caused by COVID-19. Probably there are more cases than are being recorded, and probably there are more deaths. We do know that COVID-19 is less infectious than the flu, but has a much higher mortality rate. So really it's about the spread and then the death rates. So far, the death rates have been low relative to the size of populations. And when you look at history, it's true to say that death rates are much lower because we have better health systems than we used to have. Medical advances enable a faster, more effective response. And that's even with a lack of global leadership and coordination. So there's been a very rapid build-up in the last few months of vaccines in various stages of testing. Now, we don't know how long it'll take to find an effective vaccine. We don't know how long it'll take for it to be produced in big enough numbers to meet demand, or for it to become widely available. We also don't know really what future strains of the current virus there may be. So there's a lot that we really have to be frank about and say we just don't know how deadly this will be. All we can really do is try and consider what is going on in proportion to other things we know about. And I think that seasonal flu one is a pretty good one. What that, of course, means is we're coming up to that time of year when it's easier for the virus to survive and spread in the northern hemisphere. So we're not epidemiologists, we're not experts in this, but we can observe what's happening, and more importantly, try and think about what it means for whether this basically means the economy and market's going to function in different ways. So I wonder if I may just move on to looking at economies and markets then. We've shown in the next slide a way of thinking about the basic building blocks that drive economies and drive markets. So I'm just going to go look at this and see what we can observe about how the economy functions and what may have changed. So on the economy on the left side, economies are really driven by transactions that we all do, households, businesses and governments buying and selling to each other, both within and across countries. So this drives economic growth. And when we spend more or less, the income of other people that we're buying from rises or falls. So there's that direct link between spending and income. Our spending is, of course, funded by our own income. And if we borrow, we can spend more than our incomes, and if we are paying back debt, we spend less than usual. So this is really the role that debt plays. So we have economies where we can boost our spending by borrowing more, but then we have to pay it back and that reduces. So these are key features of the way the economies work, and then how governments work. So government plays a dominant role in all economies in spending and in reallocating wealth and income via taxes, and with the central banks using their power to change interest rates and regulate bank and lending policies and print money to either slow down or speed up economic growth by making the cost of borrowing lower and easier to access money, or vice versa. So this is really how the modern economy works in terms of the role each of us play, including governments. I put down there 2 prices that are really driven by the amount we spend divided by the quantity of goods and services. And so prices move up when spending increases by more than the quantity of goods and services increases, and then prices move down when spending decreases by more than goods and services reduce. So this is the basic functioning of how growth works, how inflation works, and in the long run, our living standards are dictated by our ability to learn and innovate. So all of these mechanisms and cause-effect drivers of growth inflation are still in place, and the economies have actually continued to behave in a predictable way, given the changes in spending we've seen by households, businesses, and governments, even during the pandemic. But what I think has started to change is just how much debt governments have taken on in order to fund the huge amount of extra spending they are doing to make up for the huge drop-off in spending by households and businesses. So this has obviously sped up some changes that were already in play. Governments are using central banks much more directly to fund the spending by governments by printing money, and governments are moving away from pumping up the wealth of the economy as a way to stimulate more spending by households and businesses, to instead trying to give cash more directly to businesses. So we've seen that in the response to the pandemic. Obviously, they were respond to a severe crisis in the way they historically have by spending more, but the way in which they've done that has changed. And so that increase in the amount of debt is changing the way the government's operating. This is not new. It has happened in the past in various countries, but we haven't seen it for a long time. The one thing I do just want to mention is the impact on inflation is ultimately going to depend upon spending. So there's been a lot of speculation around, oh, well, governments have moved but to borrow a lot of money. That means they're going to abandon inflation targeting. They're going to let inflation let it rip, and that'll change everything. So the key thing here really is it's more about what these changes the government's making will do to spending, because it's the spending that you need to really change dramatically to have the inflation effect. And we know from the GFC and the stimulus from the quantitative easing last summer that didn't change it, because it's really about the spending that matters. So that's a lot of material to cover, but what I'm really wanting to mention here is that economies have not changed in the way they function. We pointed out there the impact on government debt and inflation, and I'll come back to that. But really, effectively, governments, we haven't suddenly gone through and nationalized the entire economy. We haven't suddenly got a government that's fixing all the prices. We haven't suddenly got economies that don't trade with each other. None of those things have happened. So the function of the economy is the same, and we still have the same cause and effect relationships with how governments behave and how all of us behave and how that affects growth. So I want now just to move to markets. Have the way markets behave changed? So again, here I'm running through the key elements of markets, which is really about buying and selling assets from each other, whether it's houses, or whether it's shares or government bonds or anything else. So generally the assets need to generate or be able to generate some kind of cash flow. Ownership of the assets need to be permitted by governments, and there need to be laws to protect the rights of owners, of everyone, but including those who own assets. So for example, rights like control, rights like getting a share of the cash flows, whether it's rent or whether it's interest payments, whether it's dividends and process of asset sales. So those things need to be in place. There needs to be a way of finding out and agreeing a price for buying and selling an asset. There needs to be some way of buyers and sellers coming together to exchange ownership and payment to each other and to the government. And that payment to the government is tax. So these elements, again, remain unchanged. The assets have cash flows, there's ownership rights, the legal framework is still in place. What is interesting this time is that, as normally happens in recession, lease arrangements with real estate have been put under pressure because the tenants go bust. They simply can't pay the rent, but they were contracted to pay. And we've seen a more extreme version of that this time, with tenants that are still operating but have walked away or in government negotiations, because it's the government who have forced the lockdown, and therefore there is a nuance to real estate. Ultimately, real estate will still be a valuable asset because you can use the land in so many different ways. So it hasn't fundamentally changed that, but it's shown that these contracts, in terms of your rights as an owner, and need to be considered in an historical perspective as to how they can change. And we've also seen dividend payments. Governments come in and kind of outlaw those in some sectors. So there's definitely been some flexing there, but it hasn't permanently changed it. And you know, history shows you this happens every recession, every economic crisis. It's not unique. The other thing I would point out here is that markets have an element which governments control directly, which is taxation. And here, this is the connection with the economy. So we've seen a big rise in government spending, a big rise in government debt, and that's clearly creating a need and an incentive to increase tax revenue. And this is happening in a political climate where distributing from rich to poor is becoming more popular. So these changes are already starting to impact assets and have for a while, even like inflation-linked bonds, where the RPI link is being switched to CPI, and that's actually going to reduce the cost to the government quite a bit of paying interest to people who own those securities. There's a fight on at the moment on that, as well as the review that's going on with capital gains tax, and will ultimately impact the relative tax effectiveness of different assets. So tax is on the verge of material change, but actually that's always something that's been changing over time. So it's more of an evolution than a fundamental change, but it will have some impact. So what I would say there is that, again, the functioning of markets hasn't changed. The general framework of rights, we haven't had, as I said, a kind of Bolshevik revolution where the state owns everything and your rights as an owner have been wiped out. We haven't had the forbidding of transactions and exchanges, which we saw, let's say, under Mao's China. I'm giving you these examples because that's the kind of extreme change you need to see to be able to say, hey, markets will not function as they have. So having looked at the structural building blocks of how economies and markets worked, I want now just to circle back to the pandemic and how it's affecting the economy. So on the next slide, this is an analogy which looks at this issue through the lens of a medical practitioner who's treating a patient with a life-threatening condition. And these, from left to right, are a series of steps you would pass through in that process. And this analogy is really something that veteran distressed debt investor Howard Marks came up with. And I think it's a great way of thinking about the issue. So what you've got is a situation where you have this infection. The patient is effectively put into a coma. So they're basically almost taken to the point of death voluntarily. They're given life support and then they're treated. And the treatment is severe. But once that treatment's effective and there's a cure or they're cured, the patient is then allowed to be brought out of the coma and resuscitated. So if we apply this to the economy, we can think of it obviously as that, the lockdowns of the coma. You cannot function as an economy, you cannot transact, you cannot interact. We've got massive government support and spending as the life support. We've got the treatment and cure, which is really seeking to eradicate the widespread presence, which in itself requires very effective test and trace, isolation, and of course, ultimately a vaccine before completely lifting the lockdown and allowing and winding back the government spending and then putting the economy back on a more normal footing. Now, I have to I have to announce it that I have a disclosure to make, which is that I'm originally a New Zealander, and through my mother who still lives in Auckland, I can see what's happening in New Zealand, and probably they're the country that's closest to trying to have got to the state where they almost eradicated what they thought was the presence of COVID-19, moved to a fully normally functioning economy, started to pull away from government support, only to find that it reappeared. So there's just an indication, and what that basically means is in a normal life-threatening situation, maybe like in a financial crisis, where governments have to put in place a public holiday to prevent people pulling the money out the bank. They put in place mechanisms, and then they gradually go through this path. Here, we've got a zigzag going on. So every time we get an outbreak, I'm using the arrows at the bottom there to indicate this, you suddenly think that you've got to the point where you're almost able to cure them. No, you're not. So you've got to go back to lockdown. So this is really what is causing a much wider range of outcomes about what could happen to the economy, because we kind of haven't really got an effective treatment and cure. So we're still not in that situation where we are able to lift everything and return to normal, and we're continually surprised by what's going on because we haven't reached that state. And there's also ultimately a limit to how much life support can be provided, because there's a limit to how much debt governments can take on. And then this is bringing into all these trade-offs. So that's really a way of thinking about how it's affecting it. It's clearly investors are responding to this in ways we'll come back to when we look at the market outlook, because they're suddenly presuming that the state of lockdown is something that stays for a long time for some industries, and in other instances they're predicting big changes. So I'll come back to that, but that's really how we think about it. In a nutshell, the structural foundations of economies and markets have not changed. There are elements of how governments are working with debt and taxation that is starting to potentially shift, including their trade-offs with inflation, and the impact of the response to COVID and the COVID itself is causing this much wider range of uncertainty in terms of economic outcomes. That what this then moves us on to really is investor behavior and whether it has really changed.
Thank you very much, Mike. That was terrific. Now I'd like to invite people to use the Q&A functionality at the bottom of the screen, and we'll be moving on to questions and answers for participants in a few minutes' time. Thanks, Mike. Turning to Dan, Mike just mentioned around economies and markets. How about investor behavior? We haven't talked about that and the impact of the pandemic. How is it affecting your team, and how are you dealing with it?
Yeah, thanks, Martin, and welcome everyone. It is fantastic to have you with us. So yes, as we think about investor behavior, then I think we can say very clearly that it hasn't changed. And the reason for that is that investor behavior is the product of millions of years of evolution. And so what we've experienced as a species, as we've evolved over time, is ways of making decisions which has made us more successful. And the challenge is that many of those ways of making decisions have become hardwired in us as a group. And for most of our evolutionary history, they were incredibly useful. But we now find ourselves rapidly in a very different environment. So we've gone from being hunter-gatherers to being sophisticated investors, really in the blink of an eye in evolutionary terms. And so what that means is that we are making decisions using old, hardwired processes. And so when we act seemingly irrationally, it's not that we're being irrational, it's that we're using these processes that have been useful for the last couple of million years. They're just not useful at the current time. And so our behavioral biases, which we talk about a lot, are really features and not bugs of our background. But nevertheless, they do cause problems. We all know that clients and ourselves, investors, make predictable mistakes. And so what I wanted to do just very briefly is look at the type of mistakes we make that are consistent in different market conditions and are probably being seen now by advisors they've been seen in the past, and think about some things that we can do to help. So if we move on to the next slide, so that's the one. So one of the biases that I imagine advisors seeing that investors are displaying at the moment is the idea of chasing performance. And this idea of performance chasing is very well documented in the psychology literature. And there are really three sources of this type of behavior. We see it as performance chasing, but there are three deeper sources, and I've highlighted them here, that they're either caused by what we'd say is recency bias, so that idea that what has just happened to us is likely to continue. So for example, I imagine that some advisors on this call had clients who were convinced at the end of March that equity markets were done for and were going to carry on falling, and those same clients now are equally convinced that the US technology stocks can grow and become ever more expensive forever. That's a classic case of recency bias. Next is the hot hand fallacy. So this is the idea that that we can spot trends or patterns and therefore predict what's going to happen in the near term. This has been well documented. The idea comes from basketball, but it's true particularly when we think about the behavior of investment managers. This idea of managers going through a good patch or a bad patch and that having some implication on what the near-term future holds, which is why we're so often surprised by the way that investment managers perform. And thirdly, loss aversion. Now, as investors, we're often taught to think about risk aversion, but risk aversion is just really one part of loss aversion. There are investors who go from being risk averse to being risk seeking. And that's all to do with the idea that we are averse to losses. We hate losing money. And so when we have clients who are performance chasing, and we see that behavior, then the first thing we have to do is try and identify the reason why that client is performance chasing, because the way to deal with those biases will be different depending on what the source is. And one of the questions that I always find useful when you have a client in this situation is to ask them, do they want to make a change? And that may seem a very obvious question, but those of you who've been dealing with clients for a long time will know that some clients just like carping about performance. You know, they like something to grumble about, and so they'll grumble about performance. They don't really want to make a change. Well, that's fine. You know, we can all deal with a bit of grumbling. But the clients that really want to make a change, then we need to dig a little bit deeper and understand why it is that they want to make that change. And again, from that, we should get a sense of whether they want to make a change because of recency bias, i.e. they want to make a change because they believe that what's just happened is going to carry on happening. And there's one way to deal with that, or that they want to make a change because their portfolio is not doing quite as well as somebody else's. And that's the sort of hot hand fallacy that we see. Or thirdly, that they've lost some money and they're deeply uncomfortable about it. And that's the loss aversion point. And so by asking that question, starting with, do you want to make a change? And then digging a little bit deeper, why do you want to make a change? Then we can get a sense of the way to help people. And so I put on this slide a few coaching tips that may be of use to you. That the first is that when talking to clients about performance, always try and focus on the outcome rather than the recent past. And that will dial down the recency bias a little bit. It'll also help with the hot hand fallacy as well. So if we can show that a client is on track to reach their goals, then they're going to be less concerned about the fact that somebody else is doing better, or that the markets have been rough in the recent past. So again, focus on outcomes rather than the recent past if you can. Second, if a client is convinced they want to make a change, then ask them to explain why making a change would be a bad idea. Ask them to be their own devil's advocate. And what you'll find is that just helps the client to rebalance their decision making a little bit and bring them back to the center and make a more grounded, a more thoughtful decision. And then thirdly, if you can't get the client away from this idea that they really want to make a change, and you know that a change is not the right thing to do at the moment, then something that might be helpful is to say to them, well, yes, we can make a change, but we're going to make it in a week or 2 weeks' time. So to go away and have a think about it. And if you still want to do it in a week or 2 weeks' time, then we'll make that change. In reality, 2 weeks is going to make very little difference to the outcome, but over a decent period of time. But again, it gives the client time to kind of cool off and really think about that change. There may be a change in the markets over that period. And so in that way, we're dealing with some of those deep evolutionary biases that we see. So in summary, as you're thinking about how to help clients who are suffering these evolutionary biases, let's go on to the next slide, Martin, if that's okay. There's really 4 things to focus on. The first is to really understand what the cause of this seemingly irrational behavior is. The second is to prepare, to pick up on Mike's theme, to vaccinate the client. So if you prepare the client by saying, listen, during the course of our relationship, we will go through these rocky periods in markets. You'll want to do things that aren't good for the long term. Here's some of the mistakes that you're likely to make, and we're going to help you as your trusted advisor to get you through that period. The third is to frame. So I'm guessing that half the people on the call see a picture of a rabbit, the other half see a picture of a duck. The point is that the way that we frame our conversations with clients, the fact we focus on outcomes rather than recent performance, can make a real difference to that decision making. So when you have conversation with clients, just think about that framing again, because that behavior is not going to change, and so you need to overcome it. And then finally, of course, focus on being a coach, focus on getting those clients to their outcome. And so I hope that's of help as we think about the impact of behavior. But the key thing to remember is, although the client might be acting irrationally now, that behavior hasn't changed. It's just something that's deep-seated within all of us, and it's part of our role as investors and advisors to help people through those difficult periods where they seem to have changed but haven't really.
Thank you very much, Dan. Thanks for those behavioural insights. Okay, so the picture that we've been painting here is the pandemic is large and unique, but it has not fundamentally changed the way economies, markets and investors behave, although there will be some lasting changes, and an acceleration of those changes are already in train. But what does this mean for current investment opportunities? Mike?
Well, we've shown there on the screen a usual representation of the views there. I'd say that the key feature of the current environment is the pushing down of bond yields, which made future returns on government bonds very unattractive. And the role in portfolios is a bit more challenging because they're less likely to provide the kind of diversification we're used to seeing, given how low yields are. So you can see that from government bonds have become the lowest ranked of the opportunities that we see. While I'm on the negatives, the other thing that we're seeing is the current beneficiaries of the spending shifts online that we're seeing that have been accelerated by the working from home or shutdowns. Investors have seen that, and they have assumed that there will be an increase in the growth rate of those businesses going forward to what would be unprecedented levels, with a handful of major companies with having huge share price increases and really very, very high valuations. That extrapolation of recent conditions has made US equities as a whole about as unattractive as they were back in '99. So I think as we look around and we're looking for ways we can identify good opportunities that aren't all cyclical or all defensive. The things that we're seeing are continue to see attractive are Korea, which is really tied to the semiconductor cycle, and the markdown that we saw in Korea previously. Energy companies where they own the oil, and then more recently consumer goods companies where they have the ability to sustain the revenues in a variety of economic scenarios, and the prices are pretty reasonable. So we progressively added to those and introduced them into portfolios. I think in the interest of time, because we're running a bit over, I'll leave those as the main new things to highlight.
Apologies, the slide had a mind of its own there and it has moved ahead, but you're right in the interest of time. I just want to implore people to make sure you contact your BDM or call in or email us at Morningstar for more insights. Also, we have a series of behavioural seminars that we can help run for advisors and their businesses. So please also get in touch if that's of interest. If the system is working, I'm just going to finish with a quick polling question for you all, which is, what do you believe your clients are more concerned about? Losing money if the market falls, or missing out on gains if prices increase? And I'll just wait 10 seconds for that polling to come in, and then I will share the results. Over 50% of people have voted already, heading up towards 70. And I'll close that off in a second. Thank you. I'll end the polling. Losing money if the market falls is the overwhelming victor in relation to that. A whopping 94% of you believe your clients are more concerned about losing money if the market falls rather than missing out on gains if prices increase. That's interesting. Thank you very much for that. I'll close the polling. Here we go. That is it for the webinar today. I just want to say thank you very much for dialing in. That is a summary of the learning objectives, and I will leave you with the obligatory disclaimer. Just wanted to also say one last thing is that the next webinar will be on Thursday, 17th of September. We'll be covering the next installment of slides to assist advisors in communicating messages in discovery meetings. It's worth noting that these sessions have been amongst our most popular and well-received webinars. So please don't miss it. And thank you to our presenters, and thank you all for your continued support. Thank you.